Welcome to the debate. Today, we are diving into the high-octane environment of India's automotive aftermarket, and we're focusing specifically on the car washing service industry. This is a sector that's not just growing, it's undergoing a really fundamental transformation.
It really is. I mean, the market, which was valued somewhere between USD 885 million and 1.1 billion in 2024, is forecast to achieve a compound annual growth rate, a CAGR of between roughly 6 and 8.5%. That could push it up to almost $1.9 billion by 2030.
Exactly. And those are just immense growth figures, but they sort of hide this massive conflict right at the heart of the business model.
Right, because the report suggests all this growth hinges on a structural shift toward organized, technology-enabled services. But at the same time, the vast majority of current washing volume is still handled by the informal, low-cost sector.
And that brings us to our central question today. Is the projected high growth and profitability of the Indian car washing market primarily being driven by this organized high-tech sector?
Or is that potential fundamentally constrained by the enduring dominance and, frankly, the sheer competitive strength of the unorganized informal sector?
My argument today is that structural forces, we're talking regulation, rising incomes, and the absolute imperative for sustainability, are creating an inflection point where the organized sector becomes the only viable engine for future growth and superior profitability.
And I'll come at it from a different way. While I acknowledge the impressive projections, I believe those figures represent a potential that will remain largely unrealized. My position is that the market is fundamentally constrained by the sheer volume and the low-cost anchor of the unorganized sector. I think the prohibitive capital required for organized facilities, combined with immediate financial risk, severely limit scalability and realize profit across the broader market.
Well, the future of this market is defined not by consumer choice alone, but by structural necessity. We're seeing irreversible shifts driven by rapid urbanization and rising disposable incomes that are demanding higher quality services. But the true game changer here is regulation, specifically water conservation mandates. The ban on potable water for car washing in major urban centers like Bengaluru is an existential threat to the informal sector. These mandates, they fundamentally favor the organized operators because, well, only they can afford the mandatory water recycling systems. And that's a significant investment costing between 8 lakh and 25 lakh rupees per facility. This isn't just a cost, it's a competitive moat. It allows organized players to deliver professional, eco-friendly services that the emerging middle class is actively looking for. And on top of that, the profitability potential is just exceptional. Organized operators are not simply running a wash bay, they're running a full-service detailing center. Annual returns on investment are projected between 20 and 35%.
Right.
This all stems from service diversification. A basic exterior wash might only yield a 15 to 20% margin, but when you diversify into premium detailing and ceramic coatings, which these organized shops specialize in, those margins just explode to 40 to 50% and 50 to 60% respectively. This strategic focus on high-value services ensures superior returns that, the informal sector can never even touch.
I understand the attraction of those margin figures. I mean, who wouldn't want a 60% margin? But those specialized services are highly niche, and the market must first address the foundational reality. The unorganized street-based manual washers still represent 65 to 70% of the total wash volume. They are the price setter, charging between 150 and 300 rupees per basic wash. That's roughly half the price of the organized equivalent.
Sure, for a basic wash.
And this market dominance is directly tied to the massive hurdle of capital expenditure. For an organized player to even open its doors, they're looking at a total capital expenditure, or CapEx, often reaching 50 to 70 lakh rupees for infrastructure and equipment. I mean, this high barrier to entry introduces extreme financial risk. And if we look at the project reports, year one is projected to show a loss of nearly 1.8 lakh. More tellingly, the debt service coverage ratio, the DSCR, is a disastrous 0.28.
It is low in the first year, yes.
The DSCR is the metric banks look at. A ratio of 1 means you can just cover your debt. A 0.28 means for every rupee of debt service due, the business generates only 28 paisa. This model is just financially fragile from the get-go. And while profitability is projected for year 2, achieving it requires hitting a sustained, high volume of 15 to 20 vehicles daily, something that is incredibly difficult to guarantee when the competitor down the street is 50% cheaper.
Okay, so let's start with that fundamental division you've laid out: structural necessity versus cost-based reality. My argument really hinges on those regulatory changes that fundamentally restructure the industry, namely the water conservation mandates. You see these mandates as a financial burden, but I see them as a crucial competitive weapon that drives consolidation. The mandatory investment in water recycling systems is precisely the mechanism that separates the legitimate, scalable players from the informal sector. By requiring this investment, the government effectively raises the minimum standards for doing business. We are talking about organized systems that reduce water consumption by 40 to 60%. This mandate isn't just about compliance. It's about permanently eliminating the non-compliant, water-wasting, unorganized sector, especially in water-stressed urban areas. This regulatory pressure ensures that quality standards and, critically, market prices must rise over time. The government is essentially creating a clean path for formalized, sustainable growth.
I am sorry, but regulation may intend to solve the competition issue, but the financial reality dictates that it currently only creates compliance complexity and risk for the organized sector. The investment required, that 50 to 80 lakh capex, isn't just a one-time cost. The environmental compliance processes, licensing, and necessary overhead consume 10 to 15% of ongoing operating costs. In a hyper-competitive, price-sensitive market, that financial pressure has to be passed on to the consumer.
Of course.
And this is where the price gap just reinforces the power of the unorganized sector. The price-conscious middle-class family segment constitutes a huge volume of the market. They might appreciate the idea of water conservation, but if the choice is paying $150 for a manual wash today or $350 for a compliant, organized wash, the vast majority are going to stick with the low-cost option. Regulation acts as a moat for a few high-capital players, sure, but it doesn't automatically shift the demand curve for the broader market majority. They remain loyal to affordability.
But the demand curve is shifting, even if slowly. The organized sector isn't competing on price for a basic exterior wash. They are competing on value and differentiated service quality. And let's pivot to my strongest evidence: those high-margin services. The ability to charge 50 to 60% margins on detailing proves that this business model is insulated from the low-cost volume war. The formal sector is transforming from a basic maintenance commodity to, a specialized vehicle service provider. They capture the wallet share for premium services that require capital-intensive equipment and expertise, which the street vendors simply can't offer. This diversification ensures profitability even if basic wash volume remains contested.
That's a compelling point regarding margin isolation, but have you considered the sheer challenge of scale? I mean, focusing on 60% margin premium services means you are consciously appealing to a tiny fraction of the market. Let's look at the segments. The market reports confirm that mobile and subscription services, while growing fast, mobile at 7.25% CAGR, represent a tiny market share, only 5 to 7% for now. The backbone of organized revenue is still the traditional rollover and in-bay automatic systems. They captured over 62% of 2024 revenue. And a rollover system is essentially a machine that drives over the car while it's stationary. It's a high-volume process, but it's still basic cleaning. The truly high-premium models you're championing, mobile services charging 20 to 50% more, or subscriptions priced at 1,200 to 2,500 rupees monthly, only really appeal to the urban professional segment. That's maybe 30 to 35% of service revenue. So if 70% of the volume is low cost and your highest margins only apply to 30% of the market, aren't you proving my point that the organized sector is fundamentally just capturing a premium niche rather than achieving the mass market scale needed to justify that overall billion-dollar growth forecast?
I think we have to redefine what scale means in this context. It's not about capturing every single car. It's about capturing the most reliable revenue stream. You're correct that high-value services are niche, But convenience drives repetition and loyalty, which translates directly into predictable long-term customer value. Subscription plans are a stabilizing force here. They radically change the unit economics compared to a volatile one-off street wash. The data shows subscriptions improve customer retention by 40 to 50%. Furthermore, we have to look beyond individual consumers to institutional demand. Fleet and commercial operators, taxis, logistics companies, they require regular, professional, audited washing for vehicle maintenance and brand image. These institutional contracts provide stable, high-volume revenue streams, contributing 8 to 12% of volume that are completely inaccessible to the informal market. This scaled, reliable growth overcomes the volume volatility you're citing. Organized players aren't just selling a wash. They are selling certainty and compliance to businesses.
That's a fair assessment of institutional contracts. I'll grant you that. But institutional demand only mitigates, it doesn't eliminate, the fundamental operational risks facing the organized sector. My final point revolves around this operational risk, specifically location dependency. The report explicitly emphasizes that profitability hinges on unit economics. You absolutely must hit 15 to 20 vehicles daily to achieve that 25 to 30% operating margin. Success is inextricably linked to location quality. Sites in affluent neighborhoods show 40 to 60% higher volume.
Right, which is just smart business.
But while you frame strategic site selection as a control factor, I see it as a huge operational constraint. If a business must be in a high-traffic, affluent area to succeed, it immediately faces high fixed costs, with leases often ranging from 30,000 to 50,000 rupees a month. This high rent and the limited availability of suitable commercial real estate severely constrains market expansion potential for organized chains. They can't just set up anywhere. The model is inherently fragile. You are relying on achieving that high utilization rate to reach viability, but the business is highly susceptible to external risks. Monsoon seasons drastically reduce demand, and economic cycle sensitivity means washing is a discretionary service consumers cut first during a slowdown.
But those risks are manageable.
I'm just not convinced by the idea that these risks are easily mitigated through planning. The initial high capex, combined with high fixed operating costs, means that any dip in volume for external reasons, weather, traffic diversion, local competition, can instantly push the operation back into the red. That early fragility is exactly why the DSCR is 0.28 in year 1, only finally reaching an acceptable 1.31 in year 2. It's a risky high-wire act, not a stable growth model.
The risk is manageable because the high fixed costs are justified by the high lifetime value of the customer. You focus heavily on the capital outlay, but every single metric indicates a rapid path to recovery. The low break-even point, just 12 vehicles daily, is achievable within the first 2 to 3 months, according to projections. If you can reach operational efficiency that quickly, the high margins from specialized services begin generating cash flow almost immediately, allowing the operator to service the debt and secure those long-term returns. Location dependency, while leading to high rent, simultaneously provides guaranteed access to the urban professional segment, which is the segment willing to pay for premium services. The strategy is clear. Pay high rent for high-income access, secure high margins through detailing, and use subscriptions to ensure stable volume, all of which shields the organized player from the risks inherent in competing for low-price volume.
But that rapid path to viability only works in the absolute best-case scenario locations, of which there are few. If the entire profitability of the market rests on finding and securing those limited, high-traffic, affluent sites, the market growth cannot scale to the billion-dollar projections we cited at the start. Scalability means replicability. If your model fails the moment you move into a slightly less affluent area or face stronger monsoon seasons, the potential for widespread organized growth is limited. The competitive anchor of the low-cost street wash, which faces none of these high fixed costs, fundamentally restricts how fast and how far the organized sector can expand beyond those premium urban niches.
Well, to summarize my position, the data clearly shows that the Indian car washing market is at a genuine inflection point. The traditional informal players are being systematically displaced by organized services driven by regulatory pressure that mandates compliance and a shifting consumer demand for higher quality specialized care. Despite the initial high capital outlay, the key success factors, mandatory water recycling, diversification into high-margin services like ceramic coating, and stable fleet and subscription contracts ensure that the organized sector is uniquely positioned for superior financial performance and strong returns. This is what's driving the overall market growth forecast to 2030. The future is formalized.
And I, as I said, come at it from a different way. While the organized sector offers compelling high margins in niche services, the overall realization of that market growth remains fundamentally constrained by the sheer volume and the price anchor set by the unorganized sector. The high investment required, that 50 to 70 lakh capex, and the complex regulatory burden mean that truly successful organized operations will be limited to exceptionally high-quality locations and specialized premium offerings. This leaves the vast majority of the washing volume untouched, confirming that the mass market potential of this industry is currently limited by the existing competitive structure and high operational risk.
Ultimately, the viability of these strong growth projections depends heavily on which force proves stronger in the coming years of market consolidation, the structural drivers favoring organization and compliance,
or the enduring power of low-cost competition and the vast affordability gap. It will be fascinating to see whether the regulatory hand or the consumer wallet dictates the trajectory of this billion-dollar industry.